Hey, Brad Mavis, Mavis Group CFOs. Wanted to talk a little bit about the supply chain disruption as it relates to the employee retention tax credit. So, as you might know, we do a lot of work in and around employee retention tax credits. It's very nuanced, lots of rules, lots of regulations around this. But it's really fun work, and it's fun work because this is something that one, it can be very meaningful for business owners in terms of the substantial money and substantial it's a lot of money when it's done right. So, but because there's so much complexity, a lot of people kind of get scared off by it. So, wanted to share, one of the third qualifier today, which is called the supply chain disruption. And so this is probably one of the most least used qualifiers in the employee retention tax credits, but it's an important one nonetheless, especially as you look back to 2020 when we had a lot of qualifying supply chain disruption events. And so what the IRS says is there's three qualifiers to qualify for these tax credits. Number one is basically you had a revenue reduction that met a certain threshold. Number two is that you were partially or fully shut down for a period of time, and I have a video on that as well. And then the third one is that you have a supply chain disruption. And so what a supply chain disruption means is that if your suppliers were unable to deliver critical goods and supplies to you because they themselves were forced to either partially or fully shut down, then your business qualifies during the time period that you're unable to get these supplies. So there's a bunch of kind of ambiguity around that supply chain disruption. And I think probably the biggest mistake that we see people making is we've heard a ton about COVID supply chain disruptions, but it really comes from the supply chain disruptions come from what economists call a demand side shock. And so what a demand side shock means is that, for example, we'll use 3M. 3M is a company that makes a lot of personal protective equipment. And in 2020, they're an essential manufacturer, and there was a demand side shock. So all the everybody needed personal protective equipment, and so in order to meet that demand, 3M had to divert equipment and supplies to certain customers. So hospitals were primary customers, and first responders were primary customers, and folks that were lower down on that priority list found it very difficult to get supplies. That's a demand side shock. So that's different, and that's not necessarily a qualifier for the employee retention tax credits. Now, conversely, what Congress envisioned and what the IRS explains in their rulebook is that to the extent that your suppliers were forced to shut down or modify operations or weren't able to get goods to you, then that's a qualifying event. So your supplier has to have been either fully or partially shut down, and that full or partial shutdown prevented them from getting goods and supplies to you. And you couldn't find those goods and supplies somewhere else, right? For example, you couldn't find if you buy. You couldn't find what we call a substitute in economics. This was the only supplier you could get it from. This was the only place you could get it from, and they were unable to deliver it to you. So because of all those different rules and kind of ambiguity around the supply chain disruption, we see that qualifier relied on, not as often. Now, another nuance with the supply chain disruption is that you're only eligible for the period that you were unable to get those supplies. And those supplies they had to be nominal. Sorry, they had to be more than nominal. They had to be, it couldn't be, I couldn't get this one random thing but I could you offer it. It had more of a nominal impact on your business. So, the challenge with the supply chain disruption turns into, well, if at certain periods you couldn't get supplies, or there were delays, or there were back orders, the question becomes, okay, well, what qualifies as a full or partial shutdown, and how long does a shutdown that happened on your suppliers in April, for example, how long does that tail wag, so to say? So a lot of kind of unanswered questions around supply chain disruption, but unequivocally, I can say that if you had suppliers and they were shut down and they were unable to get you critical goods and supplies, then your business certainly would qualify under the supply chain disruption. If you have any questions around the retention tax credits, what the qualifiers are, if your business qualifies, how to do the calculations, please reach out. We'll walk you through exactly what we do and how we might be able to help you maximize those credits. Thanks.